Hello, everyone. Today I'm joined by Mr. Nasir Qadree, the founder and managing partner at Zeal Capital Partners. How are you doing today, Nasir?
I'm doing well, Tony. I'm so thrilled we're finally together. I know it's been some time that we've been trying to make this happen, and today is the day.
Today
So
is the
thank
day.
you so much for the invitation.
Thanks for being here. So, what is Zeal Capital Partners and what inspired you to start the firm?
We are a mission-driven venture capital firm. We're partnering with exceptional, diverse manager teams that are rethinking the building blocks of wealth, from education to employment pathways to financial technology with the lens towards inclusion, and now health equity. And we do this through a very public investment mandate called inclusive investing, which is a five-pronged market back approach that allows us to widen our lens, yet keep alpha and impact front and center. And I came to this work. I've been investing for a little over a decade now, hard to believe. And from the beginning, I knew that getting involved and meeting with change agents, innovators, entrepreneurs who are disrupting systems across our most critical sectors like education and workforce and healthcare and financial services. I knew early on that it was right for innovation. And 10 years ago, began my investment career at a coffee shop, and fast forward, decided to become an entrepreneur and build the next generation venture capital firm.
Interesting. And so you focus on the future of work, health equity, and what other sector?
Financial technology with a lens towards inclusion, with a direct focus around narrowing the wealth, skills, and healthcare gaps.
Okay. So what economic impacts do you anticipate from the shift towards the future of work, and how can businesses and workers prepare for those changes?
Yeah, so when we think about the future of work, is honestly less about productivity, meaning like the Zooms of the world, but really focusing on the worker themselves. There are jobs that are not going to exist. There's obviously AI that's disrupting the human-centric component of the workforce. And so our focus is really focusing on technology, Tony, that are directly tied to narrowing the skills gaps between education and employment pathways.
Mm.
So we're looking at other alternative pathways around outside of 2 and 4 year degrees. We're looking also at the current worker as it relates to helping the employer reskill and upskill. So thinking about other forms of credentials, whether it's nano degrees or micro credentials or certificates that speak to a worker's competency-based skills. And so we believe that technology, as it relates to upskilling and reskilling workers, is a significant market opportunity, but also impactful as it relates to ensuring we're creating a more equitable workforce.
Are there particular skill sets that you feel will be more valuable in the future?
I think there are skill sets that are going to continue to evolve and ensure that workers and in our case, you have entrepreneurs, innovators, and investors are constantly exploring a more expansive approach, right? And so you think about how we think about the healthcare sector, right? The nursing sector is going to continue to enhance. You think about on the manufacturing back in the 70s in the manufacturing, one out of five workers were in the manufacturing space, and now you have maybe one out of 25. You exactly see that shift because of technology, for example. And so I do think it's important to recognize the power of technology, the power of AI, but also maintaining that human centric as it relates to being responsible in terms of how we use technology and AI, for example.
Sure. So when it comes to your firm, could you share how much you've raised so far, how much you have under management?
So today we're about 4.5 years in. We're about $183 million asset under management. We are proud to be backed by institutions, corporations, so FIs like Wells Fargo, and payment companies like PayPal, technology companies like Google, HBCUs like Hampton University, private foundations like Skoll Foundation and Sloan Foundation, and GPs from storied franchises like Scott Sandell from NEA, former GP Mark Perry from NEA, Jason Green, one of the founders of Emergence, the most iconic SaaS-focused venture capital firm, Josh Coltman, who's in your own backyard out of Philadelphia, who runs First Round Capital. And so we're just grateful to have these types of entities that allow us to fully execute our firm strategy and also run our day-to-day business and hire top talent.
Sure. And we often talk about the challenges that come with being a founder trying to raise capital for a company. Could you speak a little bit to the challenges or the journey you went through as a fund manager or an investment firm owner trying to raise institutional capital for your company?
Yeah, before you go into the market or decide to become an entrepreneur, the first person that has to believe it is you. As sappy as that may sound, one of the biggest pieces of my own conviction is my story. I don't reflect your traditional venture capitalists. I didn't go to Stanford. I didn't roll off a storied franchise. But I did feel very strongly I had a bit of a unique approach in terms of how I was brought up, the social Rolodex and the community of diverse entrepreneurs I was able to get to know, the investment acumen that I learned on Wall Street and throughout my venture capital career, and didn't go to business school. And so I think when you decide to start your firm and build out your investment strategy, it's really having that unique value proposition and strategy that allows you to win, allows you to be a differentiated strategy within a limited partners portfolio. And that's where my focus was, even in a bit of a tough market. So for Zeal 1, for example, Fund 1, Tony, the goal was to raise $20 million. And this was going into market January 2020, not to forecast what would happen 3, 4, 5 months later. And it was eye-opening. I actually wanted to pause, but I'm a man of faith. I felt very strongly that this was my calling. The way I constantly continue to think about and meet founders who were from the middle of the country to our urban communities, like whether it's Detroit or Des Moines, Iowa, or Denver or Atlanta, where I was born and raised, or here in our backyard in Washington, D.C., coupled with your traditional tech hotbeds like New York City and San Francisco and Boston, for example. Philly has it going on as well. I don't want to discount Philadelphia, but I definitely felt that if entrepreneurs are going to be the change agents of our country, then it has to include everyone. And then B, some of our biggest problems are also our biggest markets. And that's why I landed on these 3 categories in health equity, financial technology, and the future of work and learning. And on the other side of the table, I do think it was important as a fund manager to understand and listen. Don't lead with your own strategy, but listen to the priorities and interests of limited partners. And so that's why, honestly, the inclusive investing strategy I felt was highly differentiated, because when you think about our 5-pronged market back approach, it's 5 areas in which most limited partners are looking for the differentiation of the fund manager. For us, we believe if you're a diverse managed team, a diverse group of fund managers, bucket number 2, you will over-index your allocation into more founders of color, diverse founders, diverse management teams. We also recognize that limited partners care deeply around your sourcing capabilities, your strategy. And so as we think about going where others are not, we believe the importance of geographic inclusivity and diversity. So 74% of our companies actually are headquartered outside of your main 3 tech hotbeds, as I mentioned, Boston, New York, and San Francisco. The 4th is your strategy, your focus areas. It can be a generalist, but for us, we prefer to be category specific. And so healthcare, financial technology, and the future of work and learning. And the 5th is, I think we're just better off this way. And again, going back to our biggest problems are also our biggest markets, is impact as well. How do we think about mission-oriented companies that are disrupting systems that have not afforded, particularly folks who look like you and I and women, access and opportunity and resources as a means to achieve economic mobility across the country and at scale the globe. So collectively, sharing this inclusive investing strategy and having the strongest conviction to our limited partners when going out to raise capital, I've felt and still feel today has set us up for success, both fully executing the strategy, but also building a day-to-day operations.
Thank you. When it comes to the post-investment support that you give your portfolio companies, what have you noticed has been the most effective strategy over time, or strategies?
Yeah, I think the overarching theme when you think about once a company enters your portfolio, Tony, is we have an onboarding moment for every portfolio company. We have a dedicated head of portfolio management, where her name is Susanna Burridge, who essentially really helps us understand where do we lean in the most. And that can be a number of different areas, right? It can be helping the portfolio company think about their governance, their culture, think about talent. A lot of companies tend to raise capital and then they have liquidity to go out and beef up their talent, whether it's hire two or more engineers or beef up their sales team. The other component that we will lean into is go-to-market strategy, really helping the company think about product market fit and scaling their services or products more broadly versus pre-financing round. The third area of focus would be maybe about branding, both the founder and the product or service. And so your goal is to become a market leader, and you want to become what is important that you step up in the market and share your story and share the value prop of your product or service. And the fourth, I'd argue, is this concept of helping entrepreneurs get introduced to new investors as well. It's never too early to raise capital. And as you raise a seed round, for example, start having those relationships, even if it's one or two introductory calls when you're not raising, understanding who further up the capital stack is putting money in your category, and being proactive as early stage investors to make those connections is critical as well.
Thank you. In terms of fintech or financial technology, what solutions do you feel are the most viable for helping to reduce the wealth inequality? And what examples in your portfolio are currently illustrating this potential?
So look at it from maybe three subcategories that we focus on. We focus on four, but I'll just name three out of the four. The first is thinking about credit access expansion. So these are innovations that really support consumers who have little to no credit and giving them an alternative pathway to increase their FICO score. A great example of this is a company called Asusu, who I believe you've highlighted Wamil Abbey and Samir Gold over the years. One of the few Black-led billion-dollar businesses. We invested at a very early stage. They're a great example of a company that's tackling a huge market and also impactful business as well. Another is around how we think about credit and just bias, combating bias when accessing credit. And a great example is a company called Stratify is a great example in that regard. I think another component is thinking about infrastructure, embedded finance for new and small businesses, and thinking about a company like Icon Savings Plan that's rethinking 401ks as well. And overarching goal is to never invest in fintech technology companies that are predatory, but are directly tied to alleviating the ability to have affordable also financial services that ultimately yield narrowing the wealth gap and increasing access to economic mobility.
So are there any emerging trends in the health equity space that are interesting to you?
We're so excited to expand our lens into health equity, Tony. We spent a little under 2 years nerding out on both the demand and supply, demand being the key gaps that exist across the health equity category, and supply being the clear number of entrepreneurs that are building solutions and valuable businesses in these subcategories. And so we think about some of the areas we're looking at is access to and affordability of care. We're looking at projects that focus on mental health and wellness, companies that are focusing on women and maternal health. So companies that are primarily solutions across the entire birthing process. We just invested in a company called Seven Starling recently. Their Series A financing round that's focusing on women maternal health, really combating that stigma and providing resources for affordable and accessible resources for women who are navigating mental health. We're also looking at companies that are directly tied to SDOH, social determinants of health, so other non-clinical factors that yield poor health outcomes like housing and food security and transportation. And so this is a subcategory that really allows us to widen our lens a bit more into other categories that can potentially yield poor health outcomes, where technology is critical to really being a meaningful solution.
Right. Wow. Investing in so many industries and sectors that you are, I'm sure you come across so many inspiring stories about why these founders started the business to begin with, to solve certain issues that they were either identifying like personally or in their community or whatnot. What advice would you have for founders who are navigating the current VC market and trying to secure funding for their idea?
Sure. It's the market today, and obviously there's cycles throughout. Look at history, a bit of a history buff, and there's cycles where I'd argue, and it's actually a fact, that some of the most iconic businesses come out of our most challenging and toughest markets. This is a market like markets before where founders step up. And I do think for those that are successful are those who, as sappy as it may sound, have the strongest conviction in their idea. Number two, they understand the market. They understand the total addressable market. They understand who is in the market in terms of competition, how they differentiate from maybe others. Some have such strong conviction in their own project, they may say that there actually is no competition, but it's one of those things where, what do you believe? But most people disbelieve, and I believe that there's always someone out there trying to, compete with you. But to the TAM component, is this a winners take all, or is it large enough where if you get just 5% of the market, you can win in that market as well, and return 3, 4, 5x capital back to your investors. Another is really being disciplined around the type of cap table. I think doing the homework on investors is critical. And some founders may want to just shoot their shot and not take it a step further and really look at their portfolio and get a sense of the type of companies they're investing in. And there's a lot of information out there than it was probably 10 years ago, even definitely 20 years ago, that can better prepare and customize founders approaching venture capitalists. Of course, as you meet with venture capitalists, just being clear to tell the story very succinctly. Don't go all over the place. Being focused around why you're doing this work, the traction you've made to date, your vision in terms of some midterm goals. How are you going to get to, let's say you hit $1 million in ARR at the end of last year, and what are you going to do this year and over the next 15 to 18 months? And then even thinking about John F. Kennedy, your moonshot idea, like what's the vision of XYZ company? And so being very thoughtful and transparent and clear with your vision and traction performance, those are the things that gets investors excited and allowing them to recognize that, I don't want to miss out on this company based on all the things that they shared.
Right. What are your thoughts on the usefulness or uselessness of pitch decks?
It's a mixture of both. It's not the first thing that's imperative to me nor the broader team. Obviously, it's a great resource. When you're investing at the earliest stages, the first call for me is I want to get to know you. I want to get a sense of no form of performative in terms of practicing and verbatimly presenting the pitch, the presentation. I don't think that is authentic. I think you find the best entrepreneurs who are genuinely just want to have a conversation, share how they came to this work and some of the pitfalls they've had and what they're excited about, and maybe bombard us with questions and why they want to prefer us as their investment partner. And that becomes a great beautiful dialogue between the two of you or three of you, four of you. And then from there, it's easier to say, well, share some materials, right? So a lot of it is voiceover, sitting there taking down notes, but now you want to verify a little bit. So you verify with some collateral, and we dig a little deep and really get a sense of the alignment with our own strategy. And we, like any venture capitalist, you spend most days and weeks meeting with different founders. You say no or pass respectfully more often than you say yes, which is the nature of the business. And so it is also important that we have a clear process that is accessible and repeatable, which we do at Zeal for sure. And so that's critically important as well, is in terms of ensuring that you're making the best use of time, but also the founders having a transparent experience throughout the investment process.
And lastly, when it comes to addressing the wealth gap, what do you see your firm's role in that? And what does a closed wealth gap look like to you?
Tony, that's such a loaded question, but if you don't mind, I'm going to give one example that I'm just really excited about across our platform, which this example is what you and I chatted about prior, is that we are so blessed and grateful to be in a position to manage 50 million on behalf of Barclays. We publicly announced this strategy called BBFI, the Barclays Black Formation Investment Vehicle, focused on investing in Black-led teams at the earliest stages. One component of that, which we believe is that really differentiates our investment platform, is our ability to build track records. And we've earmarked $5 million to run a venture scout program, recognizing that there are Black functional experts who have expertise and talent, expertise in sales and product and go-to-market strategy. And they're also just as proximate as to Black-led founding teams than venture capitalists, but they don't have the liquidity, they don't have the capital, nor do they have a track record. And if we're truly going to democratize access to capital to ensure that we have more Black-led teams, for example, getting a fair swing of play at capital, then we need to diversify those that are deploying the capital. And our scout program, it allows us to have more boots on the ground equitably across the country. B, it allows us to teach functional experts how to beef up your investment acumen. So we've built Zeal-like master classes, helping these scouts who are selected learn how to screen, conduct diligence, write investment memos, and deploy capital, manage their pacing. Each scout has approximately about $125,000 to draw down from. Like a GP, they have the ability to craft their own investment mandate. And like a GP, they have to deploy the capital within 12 months. And so it is education as well, helping them understand what it feels like to be a GP. The other bucket is build the track record. And for those companies that go off and do well, God willing, they're able to generate the wealth in terms of they're based on the term sheet. There's a good chance they benefit from the liquidity events that could take place as well. And so that is our way of also building generational wealth, and by way of providing liquidity for Black functional experts, and then also providing liquidity, even if it's small checks, to Black-led teams as well.
So, well, Nasir, thank you so much for sharing all your insights about the industry and the amazing stuff you're doing at Zeal Capital Partners. Looking forward to catching up with you about all the amazing stuff you're doing on the back end. And thank you so much for stopping by.
Bless you so much, Tony. I really appreciate it. And your leadership does not go unnoticed. So I look forward to spending more time in the near future.
Thank you. Take care. Have a great day.
You too. Be well.